just this case I did a few weeks ago. It was a family, and it was a very wealthy family. I won't give you the numbers, but it was considerably more than $30 million. And they had a couple of current financial planners. Financial planner said, call Bob Mondo. You've got some potential tax issues here. And so what I did is I created that family bypass trust. I created that intentionally defective grantor trust, and then sent it to the financial planners. Now, the financial planners' job, and they did most of the heavy lifting. They then have to take the existing investments and transfer them into the intentionally defective grantor trust. And it's setting it up. I personally would never be able to do that. I'm not a financial planner. I don't know the ins and outs of what to do. Chris, you would have no problem doing it.
Well, we have a
One of
department.
the things that, I'm sorry?
I was going to say, we have a department to handle
Yes.
all of that, so it gets done.
Right. So it's hand in glove, you and I. And so the process is I prepare the documents, I give the advice, this is what we should do structurally, and then you as the financial planner, you act on that structure and you make those assets grow, is really what you do. But the first thing that we had to do was we had to retitle a bunch of different brokerage accounts and LLCs into the IDGT. And so there was a lot of concern, and it was a big custodian that did this, and they didn't understand. I had to explain it to them that it is a like-kind exchange because those old brokerage accounts, as well as the IDGT, still use the same grantor social security numbers. So it's it's a like-kind exchange. Not a 1031 exchange, it's an in-kind exchange. So there was no liquidation of assets. There was no capital gains. The investments went from this to that with no impact.
Yeah, easy breezy. Do you ever run into challenges between estate planning and financial planning mindsets?
No, because we're doing the right thing. It's all about the client's well-being. And I really don't get any pushback. Oh, we're doing it wrong. No, I don't get those. I get these. What do you think we should do with this?
Yeah, that's good.
I'll tell you, one of the challenging ones is I had a client of mine, great guy. I love him. I miss him to this day. And he passed away, I want to say in November of last year. I did his estate planning. He did not disclose to me that he had all these assets. He owned several buildings and all these financial assets. Great guy, but very tight-lipped on those things.
Yeah.
Well, I just did a regular old revocable trust for him. Well, it turns out that he was still married and he had about $17 million worth of assets.
What a missed opportunity.
Right? And so here's what happened. He named his 3 sons as the beneficiaries on his revocable trust. And I knew if we were going to do it this way, they were a big chunk of it, $13 million is going to be taxed at about 20% plus the feds, right? So you got the feds at 13 point something. So there was a federal tax bill there of 40% of whatever it is, because the feds give you dollar for dollar credit for any state, or the state gives, the opposite way. So I came up with a plan, and I told the 3 boys, I said, here's what we need to do. You guys need to waive your rights to all of the assets. And because in the trust that I write, if there's no beneficiaries left, it follows what is called intestate succession. In intestate, it means that somebody passed away without a will.
Mm-hmm.
And succession means, well, you know what succession means, who gets it. And so what that legislation determines is if there is a surviving spouse, all of the assets go to that surviving spouse. All of it, 100%.
And that was this person's intention, wasn't it?
No, it was not.
Oh.
It was all wanted to go to the boys.